Hello, I'm here with Thomas Emanuel from STR. Now, Thomas, you gave a talk earlier this morning, very informative talk about the state of the African market and the performance. What are the headline numbers telling us?
The headline numbers, well, if we look at Africa as a whole, I think firstly it's difficult to do so because it's such a vast continent, 54 different countries, very different countries at that. So if we look at Northern Africa first of all, it's still struggling.
Yeah.
It's down 1% in RevPAR terms August year to date, which doesn't seem that bad, but we're talking about several years of decline post the Arab Spring.
Yeah.
Effectively the tourism market is decimated in Egypt, in Tunisia, etc. Although we're seeing some recovery in markets like Cairo and Casablanca, it's still a fairly difficult trading situation. I think sub-Saharan Africa is a bit more of a mixed bag.
Yep.
Generically speaking, it's being driven by the weak South African rand. So South Africa's doing well. It's an affordable destination for visitors to go to. But there are also a number of other cities and countries that are challenged in a number of ways. So there's obviously safety concerns, commodity price declines, oil price declines. We've seen some new supply come into some markets such as Accra, which is having an effect, also Nairobi, China slowing down, strong US dollar. So there are a number of challenges, but I think also supply growth remains fairly low. It's averaging 1.2% this year to date. So there are still plentiful opportunities and the pipeline is still relatively robust in a number of markets.
And one of the things that I seem to remember and took from it is how sort of low the occupancy rate overall is, but actually RevPAR has stayed quite steady growth.
Yeah, absolutely.
So what does that actually tell us?
I mean, what that tells us is in a number of markets, we've got low occupancies. I mean, there's no escaping that fact. When you compare it internationally, it is low.
Yeah, it's 54%?
54% across the continent. If you look at some of the southern African markets like Cape Town, Joburg, Windhoek, Dar es Salaam, they're sort of 65, 70%. So they're performing a lot better, but there are a number that are dragging things down, predominantly due to the safety situation. So we look at Tunis, we look at Sharm el Sheikh, very low occupancies. Lagos also, safety concerns there, falling oil prices mentioned, low occupancies. But where Africa is doing well and continues to do well is from an average rate perspective. We've got some of the highest average rates in a US dollar situation, really when we compare things globally. So somewhere like Addis Ababa, due to its high-end supply, about 200, I think it's 217 US dollar average rate. Lagos is 187 US dollars, Accra is 183 US dollars. So very high average rates that are being pushed continually by hoteliers, which is really the one thing they can do when demand is not there. So when we put all that together, the good news for Africa as a whole is that on a 12-month moving average, we've now seen 50 consecutive months of RevPAR growth.
With all the talk of a need for more branded rooms in Africa, if occupancy remains low, is that a danger, or is this just other things influencing that?
I think it's there are multiple factors influencing it, from a political, a macroeconomic scenario, obviously from a safety scenario as well. Where I see the opportunities is there are still a number of countries. I mean, there are 7 countries across Africa with no brands hotels at all, and there are still a further 4 where there are only African brands present. And for me, there must be opportunities there. I mean, where there is literally no supply. As we get a growing African middle class, more disposable income, better air connectivity, the continent opening up to international visitors, they're going to want somewhere to stay. And I think not only those where there's nothing, I think there are still a number of markets where we're talking about populations of 1 or 2 million in a city, and there's maybe 1 or 2 hotels. And if you compare that to a developed market, a Europe or an America, it's very different. If we think of Kigali, where we're obviously enjoying the hospitality at the moment, until the Radisson Blu and the Marriott opened in the last 2 months, there was a couple of African brands, and that was it, and Serena of course as well. So these big multinational brands, they know where they're going to make money, and they're obviously focusing on Africa because there's still a wealth of opportunity here, I think.
So what's the future looking like for STR in Africa to finish up?
I think the future's looking bright.
Yeah.
I think we as a business, we work with all of the global brands. We're very proud to do so. We're now working with over 760 hotels in Africa, and that number will only increase as the supply gets bigger. We're also putting a lot of effort into going into new markets such as Kigali. We did it last year in Maputo, for example. We did it in Tunis. We did it in Addis, where we're going and we're speaking to independent hoteliers, educating them on the benefit of benchmarking. The more transparency, the more data that's available, the more investment that's likely to be channeled into the continent. So, it's a challenging market. There's no denying that, and things take time. But I think certainly in the long term, Africa remains a really important piece of the puzzle for STR.
Well, Thomas, thanks so much for joining us today and giving such an informative session. I've never seen so many people taking photos with their iPhones at the slide, so thanks very much.
Much appreciated.
Cheers,
Thank you, Matt.
Thank you.